Hey everyone, my name's Andy. My channel's Finding Value. I'm going to go over one clip that I did a long time ago, but I want to make sure everyone hears it. If you're a new subscriber, I know a lot of people watch my newer videos. They don't go back and watch my older ones. So I'm going to go over this because it's such an important topic and thing to understand that I think you have to go over it, and I have to have everybody understand this. I may even go over it to a couple months from now and then another couple months to refresh everybody. But this is probably the most important clip that someone should watch on YouTube. So I'm going to go through this, if you're an investor at least. Go through this called Identifying Value and Conditions. So one, you have to understand our currency. The Fed creates money through open market operations. It goes through that, and basically what they do is they print money, they create a bond, money comes from the Fed Reserve, and that Fed Reserve pushes it into the banks, the commercial banks. Those are known as bank reserves. Bank reserves are then multiplied through fractional reserve lending. So basically what this means is that the commercial banks have to lend a whole bunch of money into existence. Otherwise, it would not exist in the system and circulate. It would just sit on the bank's reserves. That is what people refer to as low money velocity. Fractional reserve banking is a system in which only a fraction of the bank deposits are backed by actual cash on hand and available for withdrawal. So we know that the loaning of money comes through the commercial banking sector. So what is the majority of the commercial banking sector? Where do those loans go? And how can it expand our currency system? I know this seems kind of confusing if you've never heard this before. So the commercial bank lending, the vast majority of money, 97%, comes into existence when commercial banks extend a loan. That's where the majority of money comes from, 97% of it. Now, there's four things that these loans go to. I'm going to focus on the big one. The big one is 50% go to mortgages, mainly on existing residential property. So the majority of the loaning goes to mortgages on residential real estate. And one thing to keep in mind is that when a new house is built and they create a loan on it, that loan is 100% increasing the money supply because it didn't replace another loan. It's a brand new loan on a brand new house. So that's very inflationary. This is demographics. We've got male, female. The things I want to point out is this group, which is the baby boomers, is a little bit smaller than the millennials here. The millennials are coming up into their prime years of buying homes. They're having starting families, and they're looking to buy homes. This demographic, larger population is going to want more homes, and it's going to require us to build more new homes. The demand for new homes is going to increase because the overall aggregate demand for homes is larger in this population sector. So identifying value. So real estate, you have to identify where you are in the cycle of real estate. You need to understand the metrics, days on the market, inventory, foreclosures, deficits, prices, etc. Then we've got the ratios. This is relative value. S&P 500 to commodities, Dow to gold, gold to oil, real estate to gold. These are all ratios telling us relative value over time. So the real estate metrics, that's what tells us real time how the real estate market is doing. Right now, we have record low inventory. We have very short days on the market. Housing starts barely above the yearly demand. Foreclosures are extremely low. And the demand-supply balance is a deficit of 3.5 million homes nationwide. Yearly demand for new homes is roughly 1.5 million per year. We have to build above the 1.5 yearly demand another additional 3.5 million new homes nationwide. And I'm going to show you what that looks like and why that happened. So this is housing starts. This is supply of new housing over time. The red line I put in here is your yearly demand. So whenever you go above this too much, like here, you have an oversupply and it's going to have to come back under this for a short while. But the reason this went up so much is because the baby boomers, a larger demographic, was coming in and buying more new homes. That's why it went up so high here. Very inflationary in this period. and we built a whole bunch of new homes. It declined, and you can see the cycle here. This right here was a problem because we had artificial demand with bad loans. Not only were we in an this right here is a hypersupply phase. It's an expansion phase. So we built too many homes, and a whole bunch of foreclosures came on the market at the exact time we built too many homes. What that did was it destroyed the real estate market. It destroyed new housing starts. That's why you see all these down here. We spent over 10 years down here building less new homes than the lowest in history here, well, the past all the way to 68. In 1982, we built all these lower than the lowest in history right here. And this created a gigantic deficit in new homes. Approximately 3.5 million is that deficit. So coming forward, we're going to have to build above this red line here, 3.5 million homes. So if you look, the deficit here and the deficit here is going to have to be made up somewhere over here. But we built too many here. So some of these were sucked up in the foreclosures and were purchased in this, we'll call it recovery, recession phase in the housing market. But we need to build a lot more going forward. So I'm just going to go over quick the real estate cycle. We've got the recovery phase, which is, this is your 1.5 million home long-term occupancy average. That's the 1.5 million. When you're below 1.5 million and it's increasing, that's a recovery phase. Then we go into an expansion phase, we go into a hypersupply phase up here, and then we go into recession. That's the cycle. So what I did here is, this is also a housing starts, new privately owned housing starts. This is time, this is your number of units, the 1.5 million roughly is in here. And then I overlaid the commodity to S&P 500 ratio on this housing starts. That's what the green cycle in red is. That's what this is. This is cheap commodities is the green, expensive commodities is the red. Now look how this, when overlaid over the housing starts, paints a clear picture of what drives inflation and commodity cycles. And what this is this is the real estate cycle going back and forth. We can see it in the housing starts. So this is recession, recovery, expansion, hypersupply, recession, recovery, and then notice how we've got a lot of area under the curve here. We need to build more homes. We had this big spike in an expansion phase of real estate. This is when the commodity super cycle aligned. It aligned roughly in this area right in here, and the top was up here. It was an expansion phase of real estate. Again, in 98 to 2008, that was an expansion phase of real estate. That's why the housing starts went up. This is where the inflation came from, was right here, because we were in an expansion phase. And when you're in this large expansion phase, house prices are going up, which means loans are getting larger in coming into existence on existing homes, and they're coming in on more new homes being built, which is 100% inflationary. So this is it all overlaid. And we're running this right now. We're cheap on the commodities front here. Overlaid on the housing starts is giving us a green sign in this entire area, meaning that we are entering a commodities super cycle right now. And we are about to enter the housing starts into an expansion phase. So everything is aligning. This is your alignment. This is telling you that the commodities are cheap and that we should be entering commodities. This is telling you that the market conditions are ripe for a commodities boom. That's why I'm showing this housing starts presentation here, this picture. This is the market conditions. This is the valuation. Now, I overlaid this, commodities cheap, commodities expensive, on some price charts to show you how well it predicts. This is oil price, and I overlaid, these are supposed to be green, they're black, and these are red, the tops. So huge move higher, and we're putting in a very big bottom here, and we're gonna go way higher. Now, if you drew a line through here, I think we're gonna go way up here, probably $200, $300, $400. I'm not sure what the exact price is. But this is overlaid on this chart to show you what the returns are if you had purchased in these green bubbles. If you bought here and then you sold at the red bubble, sold here, bought here, sold there, bought here, we're going to sell way up out of this, off the screen. This is those same things overlaid on the gold to oil ratio. And it aligns with cheap and expensive, cheap and expensive, cheap and expensive. It'll come all the way down here. They overlay perfectly. We have that perfect alignment, so to speak. And here, I just have the uranium price, because I know we've got a lot of uranium bulls. 72 and 2000 is when they really took off. And if you go back here, 72 and 2000 is right in here. That aligns perfectly. And we're going to see a uranium bull market in prices very soon, probably now. Another thing to think of, this is the commodity index to Dow Jones ratio. I'm just showing you that in a long-term perspective, we haven't been this cheap in 100 years. I mean, look at that. We are way down there with the cheapest it's ever been. Now, if we get one of these big ramp ups like this, we have a massive increase in purchasing power that is shifted to us through those investments. This is the Dow to gold ratio. Again, this is cheap at the bottom, expensive at the top. Right now, we are heading down, which means that gold is outperforming the Dow. And that's what I look at in my ratio updates. We go over all this. Again, this is long-term interest rates. And if you look, this is tied to population, ultimately. These long-term movements. From 50 to 80, that was a big boom in population in America. That's a demographics move. Now, what do people do when they go into wars? They all die. Interest rates went down when all of these people died. I'm not trying to be mean. I'm just telling you that the population shrank during that time frame, and that's why interest rates declined. We went from baby boomers, this was all Gen X, all the way down to millennials. Now, the millennials are a little bit bigger. I'm expecting interest rates to go higher because of demographics. That's my thesis here. Japan has had a very rough time because their demographics is completely different than America. They have declining population, which means they have declining real estate, which means they have declining, it would be deflation then, a terminal deflation because of demographics. And here's the M2 money stock. This is money. This is going up. It's inflationary. That's what it is. So the conclusion here is the new home build deficit of 3.5 million is going to drive real estate higher. That's why real estate prices are going higher. Whatever metrics you're looking at, they are going higher. That's why inventory is non-existent with all this real estate. That's why people can't get homes. It's very difficult. That is why it's difficult to find a new home right now, or to find a house right now. And they got to build a whole bunch more. So new home starts are going to have to go into an expansion phase. It's going to be a gigantic expansion phase as well. And I expect it to be very inflationary. Higher prices will drive inflation. Commodities will outperform. Gold's the leader, and it's been outperforming stocks. That's another indicator. We've got interest rates are supposed to be held low by the Fed, and a lot of base money created, which is going to flood into the reserves of the commercial banks, which will then get loaned into existence for all these new homes. And negative real rates fuel commodities. Negative real rate means that you have the inflation rate greater than your 10-year yield. That is negative. People are going to sell their bonds, and that money is going to flow out of bonds into something else. In an increasing interest rate environment, stocks and bonds do not like that environment. It's going to flow to commodities. And that's where the value is telling us where it's at. It's commodities. That's where the value's at. If everyone already owns stocks and no one owns commodities, that money's going to flow out of stocks and go somewhere. It's probably going to be in commodities. And that's usually what the money rotation is. So the potential investments, in my opinion, are these: physical platinum, physical silver, uranium, natural gas and oil producers, and a bunch of base metals: copper, nickel, cobalt, lithium. And this channel goes over all of those things. We go into all of those investments. I tell you what I'm doing in those investments when I'm buying things. I'm telling you companies that I prefer and what I like to go into. Obviously, it's just for financial educational purposes. You guys can do and choose whatever companies you want. But I'm just saying these sectors are the ones that I am definitely focusing in on because of market conditions, because of valuations, because of demographics, because of real estate and the inflation. everything's aligning where these are going to absolutely blow it out of the water. That's my opinion. So if you guys like this content, give me a thumbs up, subscribe, let your friends know, or take advantage, find some investments in some of these sectors, whatever you like. It could be ETFs, it can be mutual funds, it can be individual companies. You can play this any way you want. I'm playing it through physical precious metals, and then I've got my speculative portfolio, which I just swing for home runs in. I'm very on the opposite ends of the spectrum. I only hold a couple in the middle. I also play with a lot of royalty companies too, but I do own some diversified miners in the middle that pay very large dividends and that will definitely move in a commodity super cycle. And that's why I'm in that. So if you guys like this, let me know, leave some comments, subscribe if you haven't, and this is Finding Value.